Today, an outside-in view of New Zealand housing. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian and New Zealand perspective. In its latest review of the New Zealand economy, the IMF has said that the housing market needs a close look. They say that the housing market constitutes a risk in view of borrowers' vulnerability to rising mortgage rates, high household debt, and banks' exposure to housing. The IMF said that financial stability risks from a sharp downturn in the housing market are limited, though, given high bank capitalisation, but pockets of vulnerability, particularly among recent borrowers, may exist. More broadly, there is likely to be a larger impact on consumption through wealth and sentiment effects. In a scenario of a marked housing correction, macroeconomic policy support may be needed to avoid second-round effects and a pronounced downturn. In other words, interest rates may have to be taken down again. The IMF noted that price increases in New Zealand have been higher than in other advanced economies, particularly in the post-COVID-19 period. House prices in New Zealand were already increasing faster than its peers before COVID-19, and the pandemic accelerated this trend. In fact, since 1998, prices in New Zealand have increased by over 250%, almost 4 times the average increase across the OECD countries, which is around 70%. And this trend has continued during the COVID-19 period from 2019 to 2021. House prices in New Zealand increased by close to 26%, compared with around 11% in other advanced economies. A similar trend is observed for affordability metrics, with New Zealand impacted more strongly than most other OECD countries. The IMF says comparing across countries is challenging given vastly different starting points and the diversity of quality of housing. But we can focus on changes in these metrics to assess whether affordability has improved or deteriorated over time. And they said New Zealand ranks highest in the Asia-Pacific region and is near the top among OECD countries in terms of increases in house price to income and house price to rent ratio since 2015. The IMF also said that macroprudential measures in New Zealand to alleviate the impact of the pandemic eased housing credit attainability, including for investment, further increasing demand, therefore. And the temporary removal of loan-to-value restrictions during the pandemic resulted in an increase in high loan-to-income and debt-to-income lending. A large contributor to overall demand was investor appetite, driven in part by easy attainability of high LVR mortgages for investors. Until recent policy action, including macroprudential tightening and tax policy changes, a rapid increase in high LVR investor loans fueled demand. This was particularly the case because mortgage interest payments as a share of rents were also low, resulting in lucrative opportunities for investors. However, this increase in investor demand may well have helped check the increase in rental prices to some extent. Now, the IMF says a moderation of prices has set in, but there are macroeconomic risks in both directions. The timing and depth of the turnaround in the housing market remains uncertain, they say, as house prices have proven difficult to predict. House price expectations pointed to a decline during the pandemic, which did not take place. House prices could quickly stabilise or decline sharply. A sudden and deep correction would likely have significant spillovers to the rest of the economy. Rising mortgage rates are set to further dent housing affordability, the IMF said. We can measure affordability using borrowing capacity approaches based on the maximum size of a mortgage loan attainable by a household to finance a home purchase given its income. Until recently, low mortgage rates meant that median house prices in New Zealand were about 26% higher than house prices attainable under a 30% debt service to income ratio. But the rise in mortgage rates at the end of 2021 and the projected path to 2022 are set to increase this gap to over 60% by June 2022 if house prices remain at the December 2021 level. This raises serious affordability concerns. Borrowers are vulnerable to rising interest rates, the IMF said, and New Zealand's household debt, most of it household related, is high, having increased from 158% of disposable income at the end of 2019 to 169% in June 2021. As interest rates rise, home owners, particularly those who've taken out mortgages recently with high home values, will face high interest payments relative to their incomes as their mortgages reprice. While there has been a trend towards taking out longer fixed-term mortgages, especially in 2021, when rates were at an all-time low, a vast majority of mortgages in New Zealand are at a floating rate or fixed for less than 1 year, with only 5% of owner-occupier mortgages fixed for 3 or more years. Estimates suggest that during 2022, almost 215 billion New Zealand dollars worth of mortgages will have to be rolled over at sharply higher rates. High interest payments will be a drag on private consumption and economic growth, the IMF said. Although stress tests by banks suggest that most borrowers are likely to be able to afford this increase in mortgage rates, limiting financial stability risks, interest payments as a share of disposable income are expected to increase significantly. Since their trough in June 2021, implicit interest rates on housing, calculated as a ratio of households' interest payments on housing loans over total housing loans outstanding, increased from 3.2% to 4.2% at the end of December 2021, and are expected to increase further based on the baseline projections for policy rates to 4.7% and 6.1% by June 2022 and 2023 respectively. Rising interest payments will likely constitute a drag on household private consumption and overall economic growth. In addition, survey data suggests that housing satisfaction in New Zealand is relatively low compared with the rest of the OECD, while homelessness is high. The IMF says tackling housing imbalances require a comprehensive approach, and regional initiatives will help address those imbalances. Achieving long-term housing sustainability and affordability depends critically on freeing up land supply, improving planning and zoning, and fostering infrastructure investment to enable fast-track housing development and lower construction costs. Recent amendments to the RMA and the easing of zoning restrictions to permit medium-density housing in all of the country's major cities represents a major departure from the systems in place from the 1980s that encouraged low-density, detached, single-family housing. Increasing the stock of social housing also remains important, and while increasing overall housing supply is critical, given high homelessness and rental burden, particularly in the lower income quintiles, it's also necessary to take account of distributional issues. Even with a large correction in prices, low-income New Zealanders are unlikely to be able to enter the housing market in the near term because housing costs for low-income New Zealanders have doubled as a proportion of their income since the 1980s, and home ownership rates have fallen while household debt has increased substantially. This highlights the need to increase the stock of social housing. Now, there's a couple of points here. It's interesting the IMF makes no real reference to controlling debt and controlling lending. Of course, as I've argued many times, what's really driven prices high is availability of credit and ultra-low interest rates. So we need to tighten credit availability as interest rates rise to be able to deal with this. That, of course, is highly unpopular, but actually needs to be done. The second question is, of course, how you deal with the downturn in home prices. The fact of the matter is you can't just allow house prices to continue to bubble higher forever. At some point, you have to be able to deal with a correction in house prices. Now, how that is done, over what period, and how people are supported through it becomes the big question. Because the only way out of this ultimately is to bring house prices back into relation with incomes. That requires a substantial fall in house prices over perhaps 18 months to 2 years and by as much as 40%. That, of course, is unpopular, but is the real truth. However, most politicians and even most central bankers will try to skirt around the issue and argue that supply-side issues can solve the problem. But it still comes back to this. Households are paying too much for housing. They're too highly leveraged. And as the IMF says, as a result, they are sucking the momentum out of the economy more broadly because they have less money to spend. So I think New Zealand is a really interesting study because we're going to see this same set of arguments play out in other advanced economies as well. And so to the extent that New Zealand is actually a petri dish is a question that's worth thinking about, insofar that as an experiment in how to deal with the right sizing of house prices, it could become a leading case. On the other hand, we may well find that they take rates lower again and give the housing market another boost. After all, politicians don't like to be sitting on house price falls when the election appears. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.